Welcome to Simple Investing Secrets. In this video, we'll look at the top 10 best dividend stocks to buy and hold in 2023. So before we start, please like this video and subscribe to our channel for weekly updates. Let's get started. Whether the bull market is on the verge of returning, or if the bear market isn't over, now remains a great time to load up on long-term stocks to buy and hold. Currently, there are scores of high-quality long-term stock plays that remain attractively priced. Locking down positions at more than reasonable prices, these types of stocks can generate more than satisfactory returns for your portfolio, in two ways. First, from steady returns via dividends. Many of the stocks in this category not only pay a dividend but have a solid track record of dividend growth as well. Second, and more importantly, from strong price appreciation over a long time frame. While most of the names in the long-term stocks to buy and hold category are mature, established companies, don't confuse maturity with zero growth. Dividends made up over half of the S&P 500's total return since 1990. So following a buy and hold strategy would have prevented you from locking in significant losses during the sell-offs of 2001, 2008, and 2020. And the approach can almost certainly do the same in the current market decline. Combining those three words into your investing strategy by buying and holding dividend stocks can be especially rewarding for long-term investors. So let's review our list of the top 10 best dividend stocks to buy and hold in 2023. Number 10. Abbvie, ticker, ABBV. Abbvie isn't just an ordinary dividend stock, it's a member of Dividend royalty. The drug maker has increased its dividend for 50 consecutive years, making it both a dividend aristocrat and a dividend king. Abbvie has raised its dividend payout by more than 250% since spinning off from Abbott Labs in 2013. Its dividend currently yields more than 3.8%. This pharma stock has handily beat the overall market in 2022. In addition, shareholders have significantly profited from the juicy dividends. But Abbvie loses US exclusivity for Humira next year. The autoimmune disease drug generated 36% of the company's total revenue in the first half of 2022. We think Abbvie can keep its momentum going with Humira's sales soon to decline. The impact of Humira's loss of exclusivity is baked mainly into Abbvie's share price. As a result, the stock trades at only 12 times the expected earnings. More importantly, Abbvie's slump shouldn't last very long. The company expects that it will return to sustained revenue growth quickly. We believe that Abbvie's optimism is warranted. The company already has two worthy successors to Humira on the market with Rinvoq and Skyrizi. Its lineup also features other growth drivers, including Botox, Venclexta, and Vraylar. Number 9. Brookfield Renewable, ticker, BEP, and BEPC. The best thing about Brookfield Renewable isn't its dividend. The renewable energy company offers an attractive dividend with a yield of 4.3%. So Brookfield Renewable should have no problem keeping the dividends flowing. However, the best thing about Brookfield Renewable is its growth prospects. So don't let the stock's dismal performance this year fool you. In any other case, it would be impossible for nations to reduce their carbon emissions. The fact that the cost of producing solar and onshore wind energy is already lower than that of producing gas and coal energy is also very beneficial. Thanks to its investments, Brookfield Renewable's prospects for the future are becoming even more promising. The company is acquiring Scout Clean Energy. In addition, it recently closed on the purchase of Standard Solar. Brookfield Renewable is also teaming up with Cameco to acquire nuclear power provider Westinghouse Electric. Number 8. Easterly Government Properties, ticker, DEA. Easterly Government Properties' dividend yield stands at nearly 6.6%. While that's undoubtedly an attractive level, even more significant plus is the stability of the cash flow that funds the dividends. A real estate investment trust, or REIT, is how the business is structured. Easterly focuses on leasing real estate to American government organizations. As of June 30, 2022, 98% of the REIT's lease income is in the company's own words backed by the full faith and credit of the US government. That backing from Uncle Sam hasn't seemed to help Easterly's stock much this year. Instead, the company's shares have fallen close to 30%, primarily due to worries about rising interest rates and the overall economy. But Easterly is in a solid financial position to weather the current storm. Moreover, the overall market dynamics for the company should remain favorable over the long term. As a result, investors who buy and hold this stock should enjoy solid total returns in the future. Number 7. Microsoft, ticker, MSFT. The company owns the language of business. To give a succinct summary of the larger bullish case for Microsoft. Microsoft Windows dominates the desktop operating system market with a share of almost 76% worldwide. Microsoft's forward yield of 1.21% makes it a dividend stock to buy without a second thought. It's not something that's going to make you rich, however, the company's payout ratio pings at less than 29%. This reflects that investors can trust the stability and reliability of these admittedly small passive income flows. However, keep in mind that MSFT shed 33%. In our opinion, it's a great deal considering the stalwart the company represents. Number 6. Walmart, ticker WMT. The big box retailer that seemingly everyone loves to hate but still shops there anyways, Walmart will become a necessity. According to Dividend.com, Walmart offers a forward yield of 1.61%. As with Microsoft above, it's nothing to write home about. However, the company's payout ratio pings at 38.3%, which implies a stable and predictable passive income outflow. Just as importantly, Walmart offers a slight discount in the market, down almost 4% on a year-to-date basis. Considering the consumer pressure that could be coming our way, WMT may be a steal. We think it's one of the no-brainer dividend stocks to buy. While it's not the cheapest name out there, trading at 21 times forward earnings, the company enjoys a decently stable balance sheet along with solid margins for the sector. Plus, it's gaining relevance, so capital appreciation from here is not out of the question. Number 5. Aflac, ticker AFL. One of the world's biggest suppliers of supplemental insurance coverage, Aflac always offered fundamental relevance. Things happens in life and Aflac covers financial holes imposed by insurance coverage gaps. The coronavirus pandemic sharply reinforced the idea that stuff can happen anytime. Moreover, it can be utterly devastating, thus cynically bolstering interest in Aflac. Aflac provides a forward yield of 2.37%. Again, we're not talking about millionaire-making material, though it's an improvement over the other dividend stocks to buy. Aflac currently features a payout ratio of under 30%, reflecting a dependable passive income outflow. Also, remember that the company owns a track record of 39 years of consecutive dividend increases. Another factor to consider for AFL centers on its market performance. Since the start of the year, the stock has gained nearly 16%. In contrast, the benchmark S&P 500 shed a very worrying 22% of market value. Part of Aflac's outperformance stems from the direct correlation between rising rates and rising valuations of insurance stocks. Number 4. CocaCola, ticker KO. If you had to summarize the US and its distinct take on capitalism, Coca-Cola would be right up there with this country's most iconic brands. In October of 2022, Coca-Cola carried a forward yield of 2.99%. We're getting into the healthier realm of no-brainer dividend stocks to buy in terms of payout. It does come with a higher rate of risk. Currently, its payout ratio stands at just under 70%. We wouldn't call it ideal and don't think it's unstable, just something to watch. Still, on a positive note, Coca-Cola enjoys 60 years of consecutive dividend increases. Management will likely do whatever it takes to maintain this lofty status. To be fair, KO isn't cheap, priced at 23 times forward earnings. However, it features a double-digit book growth rate over the last 3 years. Also, it enjoys very strong margins, bolstering confidence in that yield. Therefore, it's easily one of the no-brainer dividend stocks to buy. Number 3. Chevron, ticker CVX. Although a somewhat controversial figure because of its underlying hydrocarbon business, Chevron simply represents a necessity at this juncture. Sure, at the end of 2021, we were probably looking forward to building the infrastructure of a clean, renewable future. Well, someone named Vladimir Putin had other ideas regarding global stability. And with Russia blackmailing the West with hydrocarbon outflow cuts, CVX looks cynically attractive. Chevron offers a forward yield of 3.19%. While one of the more generous dividend stocks to buy compared to the major blue chips, it lags the sector average of 4.24%. But here's the deal with Chevron. First, its payout ratio sits at under 34%. Compared to other energy plays, which feature high-yield dividend traps, it's a solid dependable ratio. Also, we're talking about 35 years of consecutive dividend increases. As with some of the other dividend stocks to buy, CVX isn't cheap. It trades for 11 times forward earnings, ranking it worse than over 72% of the industry. However, it features fiscal stability and a very strong return on assets of 13.7%, indicative of a high-quality business. Number 2. Abbvie, ticker ABBV. one of the pharmaceutical companies that we've reviewed in other videos, Abbvie brings plenty of relevance to the table. However, I'm mostly interested in its Botox unit under its acquisition of Allergan. The benefit here is that people will prioritize their physical appearance as society normalizes. Cynically, that's a net positive for ABBV stock. Abbvie is also a checkmark for the inclusion of no-brainer dividend stocks to buy. Currently, the company offers a forward yield of just over 4%. Its payout ratio pings at 50.5%. From a stability standpoint, it's not astoundingly great, but it's certainly not something that will keep you up at night. Also, don't forget that Abbvie features 50 years of consecutive dividend increases. As with the other aristocrats in the space, management will not let that go without a fight. Interestingly, GuruFocus.com rates ABBV as modestly overvalued. However, it trades at 12.6 times forward earnings, which is undervalued for the industry. More broadly, investors will likely focus on its growth and profitability metrics, which are excellent across the board. Number 1. International Business Machines, ticker, IBM. Legacy tech firm IBM generates some controversy not because of anything it did. Instead, it's a painfully boring investment. For years, IBM lagged behind its tech peers as it dove headfirst into cloud computing initiatives. Unfortunately, Big Blue was late to the party. That being said, IBM has been making up for the lost time. The company commands leadership in compelling artificial intelligence and machine learning areas. IBM features a forward yield of 4.8%. This ranks very favorably to the tech sector's average yield of only 1.37%. Investors of dividend stocks to buy should also note that IBM actually gained 1% in 2022. To be fair, Big Blue also carries a big payout ratio, nearly 69%, which isn't the most favorable statistic. Still, the bottom line is that the company has 28 years of consecutive dividend increases. Finally, IBM offers itself for what we would say is a more than fair price. In October of 2022, the stock was trading at 14.3 times forward earnings, below the industry median of 22.5 times. And that concludes our list of 10 top dividend stocks to buy and hold in 2023. Which of these stocks would you like to add to your investment portfolio? Let us know in the comments below. Don't forget to like this video and subscribe to our channel for weekly updates on the best stocks to buy and cutting-edge investment strategies for building wealth. Thanks for watching and happy investing.